Okay, hello everybody. We're gonna give a few minutes so that people can trickle in.
Yeah, good idea.
While you're coming, please let me know if the chat is, if you're able to see the Q&A. The idea of this webinar is really to answer your questions. This webinar is on how to finance your business. My name is Lorna Vaz. I am the Assistant Director of the Small Business Development Center. We provide no-cost consulting to small businesses in Miami-Dade and Monroe County, so the Keys. If you are a small business that would like one-on-one consulting, be it in topics like today's webinar, which is going to be access to capital, financing your business, you can register with us. I will be leading the chat today. So I'll be putting a lot of information on the chat. Today we have Ray Juncosa. He's an access to capital consultant. Ray, if you can put the next slide. Ray was a professional banker, so he really understands the banking world, what the banks request of you if you're interested in getting a loan. A lot of what we do is education for you to truly understand what you need in order to finance your business, especially if it's a new business or if you want to scale your existing one. Okay. Um, Today, Ray is going to talk to you about how you finance your business. If you're interested in meeting with him or any other of our access to capital consultants, I will be putting the link on the chat, okay? If you have any questions, please, we have a Q&A, so feel free to ask your questions because this webinar is for you, okay? So, and one more thing that is important, this webinar is being recorded. So, I'm going to be sending you a follow-up email that will have the presentation. It will also have this webinar if you want to listen to it afterwards. And also it's going to have a lot of the links that I'm going to be putting in the chat today. Okay? Okay, so Ray, we have a really good group today. So
All right, excellent. Well, TGIF, right? Thank God it's Friday, and welcome all of you. And as Lorna mentioned, the idea here is to provide you with fundamentals and to kind of give you some insight as to what lenders are looking for in terms of potential borrowers, right? And and I must stress this that a lot of small businesses have really difficulty in embracing the numbers, as I always say, and it's so critical for all of you to understand what is required, basically. And that way, when you prepare yourself, and we do quite a bit of this assistance and access to capital. I mean, I personally, I sit as the lead for the Access to Capital Task Force at the state level and member of the committee at the national level, and I do quite a bit of assistance with clients in this area. So please, as Lorna mentioned, please feel free to later reach out, and I will be more than happy to assist you. I do a lot of coaching and mentoring and assisting clients to be connected with the appropriate lenders, and so we've had some good track record. So, so the purpose of our journey then is what, deal with these financial challenges that a lot of small businesses have, right? And as you can see, a large percentage of small businesses fail in the first 7 years, and again, this is due to what? Lack of a well-designed plan. A lot of people get tied up in the day-to-day situation of running a business, and then don't realize the importance of having a plan and embracing the numbers and understanding the financial aspects of a business, right? So key to business operations definitely is having knowledge in financial statements, and making sure that you're not overlooking the deficiencies of your operating cycle, which we'll get into. So, so what are the areas of opportunity that when we're going through this journey right now is to emphasize organizational improvements in your business, financial literacy being key element of that, educating yourself with regard to what is needed and to learn more and more about the basic financial statements that you utilize. The other issue is understanding that in this world that we live in this country, and monitoring your credit is critical. And I must say that you need to understand that credit, your FICO scores, and we'll talk a little bit about that as well. It's just a moment in time. These things can be changed in a positive way by using, some specific strategies in that regard. So, monitoring your credit and then improving the operating cycle, which is simply, how you buy products, how you sell it, and how you get paid, and all the time that the cycle uses up is also critical. And then learning to become bankable, to put this all together and be able to prepare yourself to be an attractive borrower for a lender. So I always, ask people, what are the three key financial statements in a business? And I don't know if Lorna, how we can do this in a webinar. Uh, I always like to ask the audience the question of which statement would we find the operating cycle of your business? Can anyone volunteer, or is there in the
You can
chat?
put it on, yeah, maybe in the chat.
Yeah,
Anybody?
yeah.
What's the
Anybody?
question again?
The question is, which statement would you find the operating cycle of your business?
The operating cycle. Anybody has an idea? Okay, we have one. Income statement. Oh, they
Okay,
said, uh-huh. The
all
chat
right.
is disabled.
Okay.
Let me
So
see.
actually the operating cycle, and I'm glad, thank you for volunteering. Actually, the operating cycle, you'll find that on the balance sheet, and I tell you why, because it deals with what? The inventory, which is an asset, right? And then the credit that you use to borrow or to pay for the inventory, and then the receivable, which are current assets, are actually credit sales. And then what happens is when you sell a product, it's critical to be able to get the appropriate time from creditors to allow you to sell and hopefully get paid before you have to pay them, right? So that's one of the things that but now where do I find your capacity to repay a loan? It would be clearly in your income statement, because as bankers we're going to look at your top line revenue and your bottom line revenue, which is net income, and we're going to look at the cash flow that way. So financial management deals with what? Financial literacy, and a very important part of that financial literacy is understanding sales growth and profitability of the business. So the challenges of understanding the financials, you need to know cash flow, what's available to pay the debt, operational efficiency. Again, how efficient is that cash conversion cycle, that operating cycle? The shorter it is, the better it is, right? Because if you get if you buy a product and you get good terms, and then you sell the product on credit, but you get, let's say on 30-day terms, you get paid, and let's say your creditors give you more time to pay, obviously you have much more money in your hands that you're able to reinvest in the business. And then profitability and leverage is very important to make sure that you are managing correctly your debt. If you have way too much leverage, which is really debt, right? Then obviously you become a higher risk to the bank. So today the idea is, to understand that, we're trying to help small business eliminate lack of financial knowledge by providing this kind of training and providing you with this fundamental and functional financial literacy training. So it's helping you navigate through the challenges of the numbers, right? And so, part of the trainings that we do, we call it small business finance, and the idea is, as mentioned earlier, is understanding the basics of small businesses and what will be learned to apply in your business. So financial statements, everyone, very important, very key. As you can see there, balance sheet, income statement, and cash flow statement, right? Understanding their role is critical for you as a small business owner. Um, and then understanding, and we'll talk about some trend analysis and your financial profile. So when we look at these financial statements, what are we looking at? We're looking at three statements. Income statement that tells me what? Revenue, expenses, and your profit. The balance sheet will tell me assets, what you own, liabilities, what you owe, and owner's equity is your skin in the game. The difference between assets and liabilities is your capital, right? So if you started out a business brand new with, let's say, $5,000, you know, on your balance sheet, if you didn't do, any business for the first month, you'll have a balance sheet that will say in assets, cash, 5,000, liability, 0, and capital, 5,000. That's basically the way it works. And then the statement of cash flows, what it does, it provides lenders an understanding of where the cash is in the business. And they categorize it in three areas: operating, investing, and financing. In operating, you're looking at what? Everything that you do with buying and selling, creating receivables, and then your net income. And then you have investing, whether you buy an asset or in other words, furniture or equipment, or you sell that. And financing is when you secure a loan or you pay off a loan. So in all these three categories, you'll have inflows and outflows that basically are looked at. Because let's face it, if we have two companies and one has 5 million in the on their balance sheet, but they, instead of having it sit there without any debt, if it's a company that just got a loan for $5 million, obviously they're not the same, right? Because you have one client that has no debt, and then you have another client that has a loan for $5 million. That person or that company is more leveraged, right? Now, as lenders, we love to use the tools of the trade. And I always remind everyone, every time I do these presentations, to look up, uh, and by the way, as Lorna mentioned, you guys will have access to this presentation, and it is also recorded, so you can listen to it again. But common sizing statements is a very important tool, and banks use it a lot. It's really like a comparative analysis. What we're doing is simply the following. I'll take an income statement and I'll say sales, and I'll put in parentheses, equals 100%. And then what I will do with simple math is calculate every line item, the next one, cost of goods, and the other expenses stuff. I'll calculate what the percentage of those line items are of sales. And that will automatically tell me, a lot. It's like creating an open book on your business, because when I compare one income statement from one year to the other, I will see what's been happening with the business. You may be making more money in sales, but your margins may be deteriorating. And so this is going to be a tool to ask questions about what's happening. So for you to understand what's happening to your business through this tool is invaluable in my opinion, right? And this is a, comparative financial analysis that you're doing. Then the lenders use ratio analysis, which is basically calculating your debt service coverage ratio, ratios are always like fractions, right? For example, when you're calculating debt service coverage ratio, you're looking at net operating income divided by the principal and interest for both existing debt and new debt. And that what that tells me is your ability to be able to repay the loan in your existing debt. And then finally, benchmarking is used by banks basically to compare your company to other companies like yours to make a determination if, for example, if you are a high performing company or you're middle of the road or if you're an underperforming, right? And they'll look at that by industries. Okay, very good. So do we have any questions, Lorna? Is there something in the Q&A there? I
Yes.
can't.
So let me see why my video is not. Okay. So we just have one question regarding grants. So I'm reposting. We have a newsletter. We send two newsletters per month. And in that newsletter, we will always add any grant opportunities that open up for all of our clients, as well as any other information that comes our way. I am sending the link of the newsletter, and I'm also sending the link to the Verizon Digital Ready grant. You will have to complete several online webinars in order to be eligible, but these are webinars that will help you in your business. If you are a food entrepreneur, we also have another grant from Santander. So please make sure that you do subscribe to our newsletter so that you can get information if you're interested in grants.
Very good. Thank you for that. Thank you for
No
that.
problem.
All right, so we'll continue. So then the next item is budgeting and forecasting, and then understanding the differences of the two, One is, plotting the process, the other one is really projecting into the future. And you have a budget that you do every year, that you're basing it on what you spent the previous year and your plans, etc. But when you make projections, you're projecting, and forecasting into the future. And there, obviously, that is done quite a bit in your business plans. And my recommendation is that making sure that you have the assumptions as to how you're going to get there. Because let's face it, once you're out there for a couple of years, it becomes kind of you're like a guessing game, right? So having the assumptions will paint a better picture for the lenders, and they'll always ask you for that in a business plan. And by the way, I think Lorna did a great job in putting together a template, which I now share quite a bit, Lorna, along with a video for a business plan. And I think that a lot of you would benefit significantly from looking at that to give you an idea. Because remember, for those of you, even if you're not let's say, a startup, if you're an existing business that's looking to acquire another business, you should have a business plan to it's a blueprint, letting the third parties know exactly what, plans you have and how you're headed and how you're going to do it.
Mhm.
Okay, so managing cash flow is again understanding operating cycle, understanding that cash conversion cycle, and then identifying what areas of opportunity exist, and then understanding the big difference between net income and cash flow, because let's face it, and I've had this stated many times by a lot of my clients in the past, and they'll come to me and they'll say, "Hey Ray, I don't get it, man. I pay my taxes, I had net income, whatever, but I don't have much money in the bank, and a lot of it has to do with that missing liquidity is that perhaps you have way too much money invested in inventory, or you've had too much on sales on credit, and so you're not seeing the cash come in, right? So your liquidity starts drying up. So that's why it's important to understand. And then creating strategies for improved profitability. I think everyone should dedicate some time for what I call strategic thinking. Don't get caught up in the day to day and ignore the importance of planning, right? I always say dreamers dream and planners make dreams come true. So very, very important. So how to make your business bankable? Again, you want to be able to see through the eyes of the lender to understand what they're looking for. It's going to make it a lot easier for you. You can't show up to a bank and say, "Hey, listen, lender, listen, banker, I want a loan," and he'll say, "How much you need?" And then you say, "How much you willing to give me?" That right off the bat is going to be a red flag for them. So understand what they're looking for, what the protocol is, and how to approach them. And that's what we try to do to help you. Understanding the quantitative aspects of the underwriting, because remember, when you when you request a loan, you have to go through this underwriting process. These analysts that are looking at all this information, like I told you, the statements, comparing the financial statements, calculating the ratios, all of that is being done by these analysts. So knowing what the bank is looking for is going to make it easier for you. And then the 5 C's of credit are basically a platform that's used by all lenders, which is, character, capacity, collateral, condition, and capital, which all lenders use. So, and I don't know if in this presentation I may have an opportunity to go through each and every one of them, right? And then putting this all together. So, so what should you do as a company is you want to make that assessment, okay? And you're going to look at these areas: sales revenues, your margins, what are your growth plans and asset purchases, what are your funding needs, your organizational structure. Remember, in this day and age, today, there have been changes in the standard operating procedures of SBA. So what happens now if you have a company and you have someone on the company that is a foreign owner, that they're not either a resident or a citizen, automatically it's a no-go for the SBA. So it's very important to understand that. So and for South Florida, that's been a problem. And why? Simply because South Florida is the gateway to the Americas, and you have a lot of people that have come up from Latin America and have set up businesses. They themselves may be residents or citizens now, but then they have friends that are not, and they're investing in their business, they're shareholders. So automatically, what happens is that, in the old days, as long as you were 51% owner, it was not a problem. But now, things have changed. So basically, there's not much you can do in that regard. So you need to be careful with that. So, all righty. Understanding financial statements, your break even. You need to know, well, at what level do you start making money, right? And again, this is all part of learning, financial statements, and using the right metrics and tools to get there. And in your growth plans, well, you're going to look at what assets do I need? What do I need to buy equipment? Do I need to buy more inventory? Right? All of these are all assets that or do I now decide to buy a warehouse instead of renting? Maybe I'll do that. And then your margin analysis is critical. So when you look at funding needs, we know that obviously there are two ways of doing this. You either have a capital infusion, meaning someone invests in the business, right? Becomes a shareholder with you, or you have a debt financing, right? A loan, or your investor lends you the money rather than being a shareholder. These are sources of funding, and understanding how to manage that and what impact each one has is very, very important. So equity is one, and debt is the other when we talk about funding mix. Now, when we talk about debt, be very careful. You need to understand that short-term debt is always more expensive. Remember, revolving lines of credit, you see it in your credit cards, the interest that you charge, and when you compare it to your mortgage or a term loan, you'll see that there's a big, big difference. So if you have a company, and I've come across many companies that have been able to help them to take this short-term debt and restructure it in a way that they're able to term it out. So automatically, when you term out a loan and you amortize the loan for more years, automatically the monthly payment will drop. Just like when you buy a car, you'll find that the longer the term, obviously you'll pay more interest, but the longer the term, the lower the monthly payment. The other thing is, the good thing though is that with long-term debt, it's much more predictable, right? I had this company once that I helped them. They were making money, but their expenses were starting to bite into their profit. And I noticed that they own their location. They had the property had appreciated significantly. And I said, listen, you're sitting on a gold mine there, and you're basically what you ought to do is do a cash out refinance, be able to extinguish the short-term debt that has very big monthly payments, and then you'll see that your cash flow is going to improve significantly. And that was the case. After that, they were qualifying with all kinds of other opportunities that they didn't have before. So understanding this is critical. Now, when it comes to funding sources, this is what we're involved in understanding and providing the following products. You have SBA loans. One is the SBA 7A, and which is used a lot for acquisition as well as working capital. And then you have the SBA 504, that's larger loans that, buying real estate and equipment. And then you have the usual business lines of credit. It's a revolver, so obviously these lines are a bit more expensive, but they're very flexible and they're very functional. So they do have a place in your debt box, let's call it, right? Then you have asset-based lenders that are just simply equipment financing type of companies, companies that feel more comfortable and they're more flexible with you because you have an asset that's collateralizing the transaction. And then you have the run-of-the-mill commercial loans that pretty much looks at everything. And if you get let's say a commercial real estate loan, you'll find that the down payment is a lot higher than if you get an SBA 7A. An SBA 7A, you may end up with a 10% or even less down payment versus a 25 to 30% on a real estate commercial loan. So in the previous slides, we talked about the 5 C's of credit. And, again, that's part of the process. They'll look at character. That's the first C, which is simply telling me your background and how you manage debt. Okay. And that will tell me, if you're a good candidate. Then obviously you would have to go through the process of analyzing the statements, the financial information, and utilizing, ratio analysis and benchmarking, et cetera. Organizational structure, I mentioned this earlier, is, lenders are going to want to know how much of this origin US based and how much of it's non-US based, right? How about the percentage ownership? Is this a fragmented shareholder base, meaning there are many shareholders, or do you have just a couple of majority owners? And then in this process of assessing the credit worthiness of a client, a lot of it has to do with leverage, right? Leverage is debt. Obviously, the lower the debt, the less debt you have, the more credit worthy you are. If you are up to the tilt in terms of debt, obviously you have less liquidity and you become more of a risk. And you see that in your FICO scores. And I invite you to experiment with it. The quickest way to improve your FICO score is to bring down the utilization on your revolving credits, and automatically you'll see your FICO score shoot up. So you need to manage that. You should try to keep it at 30% utilization. When you're approaching a bank and you want a loan, make sure you try to bring that utilization down as best as you can so you can have a better FICO score. So what characterizes a company that's financially strong? Well, a company that's well capitalized, meaning you have good capital, you have less debt because you have low to moderate debt level, and as a result, you have more of a cushion in situations that are problems that present themselves, right? Another thing is to have consistency in core revenues, because remember, core revenues are critical. You can have a company that from one year to another grew 2 million, from 5 million grew to 7 million. But when you look at the income statement, you'll discover that the core earnings really didn't grow that much. The reason why revenues were up is because they sold plant and equipment. So that's always carved out from the financial statements. So again, operating efficiency, understanding this, so critical. This is one of my favorite areas that I mentioned before, this cash conversion cycles. You see, you buy materials, provide services, you create an accounts payable, and then you pay the accounts payable. You have sales, and then you have the accounts receivables. That's what you call credit sales. And then obviously, if your terms are too bountiful for or too favorable for the clients, that means that it's going to take longer for you to get paid, and you want to manage that in an appropriate way. So operating cycle versus cash conversion cycle, that cash flow is critical. The timing of purchasing inventory to client and getting paid is what really enhances cash flow. So when we talk about this cash conversion cycle, it's predicated, as I mentioned on the slide, on three central factors: the number of days it takes customers to pay what they owe, the number of days it takes the business to make its product or complete the services, and the number of days a product sits in inventory before it is sold. It's all an issue of timing. This is just like when you sell, if you're in the flipping game and you buy, let's say you have $500,000 to invest ongoing, and then your target, along with expenses, is to make, 5% or 10%, say 10%. But if that property sits on the market for a whole year, and then you finally sell it at the end of the year, you've only made the 5 or 10%. However, if you're kind of churning this and let's say you're turning this 3 times a year, that 10% becomes 30%. So learn what a lender's looking for: the efficacy in the process, efficiency, financial management, and you do that a lot through, common sizing statement, understanding your margins, and understanding the operating cycle. So what are we looking for? The inventory, the turn, the accounts payable, the same thing, the speed at which it's paid, and the accounts receivable, the speed at which you're receiving your money. If you have too much past dues, if you have delinquency on your receivables, banks are gonna, if you had approached them to do receivable financing, which is using your receivables as collateral, what would happen is if you have past dues, they'll carve out the amount. And if you have concentration, if you have someone that owns 20 to 30% of your total receivables, that's a concentration risk. And then if you're providing, very, very long payment arrangements, then obviously some banks will simply carve that out too. If you have some receivables, above 90 days or even 90 days, the bank will not consider it as collateral. Okay. All right. So operating cycle versus cash flow. Remember, you have the short operating cycle, you increases cash flow and profitability. Debt management. Managing your debt is critical. Lenders will always weigh your level of indebtedness as a risk factor. Okay. I think we all know that. I think we all understand that if we owe too much, it's very difficult to get anybody else to lend you money, right? So you got to temper it in a way where you're keeping a balance. Remember, debt is a funding source, and and its size and mix is going to impact the approval process. And why is that? If I have a good mix, in other words, if I have some debt that's term, that's predictable, then I have some revolvers, then you're managing it correctly. But if all of your debt for the business is on a revolver on a higher interest rate, then obviously that's always going to be a concern. It's going to be reflected in your FICO scores. So, what are some of the factors of bankability? Well, the debt service coverage ratio is something that I talked about, and again, it's making sure for the bank to understand what availability you have, right, in your cash flow to pay existing debt as well as new debt, right? And then the reason they look at this credit score is because a credit score has already analyzed in different categories, like, for example, your payment history, right? The amount of utilization, the mix of debt. They all have percentages, but payment history. But between utilization and payment history, that makes up pretty much 65% of the actual calculation of the FICO score. So it's important to understand that. And skin in the game means, how much do you have involved in the business? How much capital? If you have very little, that means it's easier for you to walk away, right? Very easy to turn in the keys and say, well, take whatever you can. I'm not, I'm not losing anything. I don't have much in this business. So that's critical. Skin in the game. All right. All right. So we have some additional resources. Lorna, did I go too fast? I think I did, huh?
No, not at all. I think this webinar is for everybody. So if you have any questions, please let us know. This is the time to ask your questions. I wanted to add, I put in the chat, access to capital is about understanding your finance, understanding loans, but it's also about understanding your numbers, understanding your profitability or how you can make your business more profitable. It's also about using platforms such as QuickBooks to manage your finances effectively. All of these are areas that we can help you in your business journey. So we have the access to capital consultants like Ray that will analyze to see if you are loan ready. If you are not, it is okay. because there are consultants that can help you analyze the health of your business to see where to cut costs in order to increase your revenues. There are also consultants that will help you if QuickBooks is a platform that is of interest to you, how to set it up and have everything in one platform. So there's various ways to help you with the financial health of your business. The reason that our services are at no cost is because we are grant-based. This means that we receive funds from the federal government, from SBA, also from the state, and we have private also grants that provide us with the funds to help you at no cost. Okay, so I've put the link here on the chat. Please connect with us. Please register with us if you want an individual meeting with Ray. And I'm just gonna leave it. I'm just gonna give you guys a little bit more time in order to ask any questions. Remember, this is for you. We will be sending this presentation via email. Please provide us with 2 to 3 business days so that we can get the recording from the FIU Zoom department, and then we'll be sending the webinar and the PowerPoint presentation, and also again our link to connect with us for an individual Zoom session so that we can talk to you independently and individually about your business.
Yeah, I mean, take advantage of
Mhm.
all these webinars that we have. I mean, this is all at no cost, and for small businesses, that's critical. But I mean, I cannot stress the importance of understanding the financial aspects of your business. The other thing is, as you progress in your business, very critical to make sure you have the appropriate accounting support. You'd be surprised. I run across some companies that millions of dollars in top line sales, and then they've tried to move up to the next step, and they really didn't have the appropriate accounting support, and as a result, they were, stagnant. They were not able to move ahead, and they lost opportunities. So they had to go back and find the appropriate sources to be able to get the right help from a CPA that would be at the category of their category of business, and that's important. Look,
Mhm.
it's about financial management. It's about taking the time to manage your business financially, not just worried about did I sell this month, right? Because remember, you can actually sell yourself out of business. If you sell too much on credit and you buy too much inventory, then your liquidity is going to dry up, and then no one's going to want to give you any money. So managing that's why lenders go through this process of prices of credit. They want to make sure that what they're getting into, because at the end of the day, banks, what are they in business for? They're in business to make loans, charge an interest, and get paid back. Sometimes people think, oh no, the bank is in the business to take away my house or my car, whatever. Listen, banks don't like to foreclose on properties because then they have to keep it and then they have to manage it. And then sometimes many times the resale is not that profitable. They end up sometimes selling at a discount. So they much rather to be able to make sure that you're managing your debt appropriately and not run the risk of having to foreclose you, and then obviously be responsible for trying to get rid of that collateral at a perhaps a discounted scenario. So that's simply some food for thought. But take advantage of what we provide, and take charge of your business in that special way, and not just worried about your selling, but also worry about managing the financial aspects of your business.
Mhm.
You'll be
And
in better shape.
you're not alone. You have different resources. We're one of them here in Miami-Dade and Monroe County to really support you through your business journey and act as a sounding board. So we know that having a small business is a very courageous act. Um, it also comes with a lot. I know you have to do a lot and you wear a lot of hats. And that's why we exist in order to guide you so that you don't have to recreate the wheel. We provide these educational services and the one-on-one consulting to provide you with guidance. So please contact us if you're in need. We're also going to be leading many more workshops and also cohort sessions next year. So subscribe to our newsletter so that you can get the information of our resources that include the events, the workshops, the cohorts, as well as our individualized consulting. Okay, so I'm going to wrap up the webinar now. Have an incredible holiday and
Yeah,
winter
yeah. I
break.
think you have one question there, I think.
Oh, we do? Oh,
Yeah.
yeah. Thank you so much. Let me see. Okay. Oh, it was thank you so much for this webinar.
Oh,
I'll
okay.
definitely be using your services in the future.
That's great. Take
Okay.
advantage of it.
Yes,
Absolutely.
yes, we're here. And the idea of these webinars is so that you can see who is behind SBDC at FIU. Now you have two faces. We're truly here to support you. So please take advantage of it. So have
Excellent.
a great holiday break, everybody. Be safe, be safe, be safe, be safe, and be well. Bye-bye.
All right. Bye-bye.